Good evening everybody and welcome to our first lettings seminar from Maddisons. I'm delighted so many of you are here. My name is Deborah Richards. I'm your compere for the evening, and my husband has told me I've got 2 minutes in this bit because I'm a bit of a one for getting a stage and not being able to get off it, so I promise I will. We've got a great evening arranged for you. Our first seminar, Are You Ready for the Renters' Rights Act? Of course, there's been so much media attention with the Renters' Rights Act, which came into force on the 1st of May, so we are in it now. And we're hoping that this evening will bring you up to speed with what the new landscape looks like and how to survive and thrive within it. So just to give you a scene set of the agenda, after me we're going to hand over to James, my husband, also co-owner of Maddisons, who heads up our lettings department. So he's going to set the scene a bit more about what's happened. I'm then going to hand over to Darren Forrester from Bury & Lambert's, who's going to give you the real legal detail about what's going on. And then we'll have Jack Sales from TN Accountancy, who's going to bring all the digital, the tax aspect more. I'm so in my head about making tax digital still. So a tax aspect. Then we're going to have a bit of a break, a comfort break. And then we're going to hand over to Paul Champlino, our sort of guest speaker, star speaker, to bring some real fun and insights on the whole new landscape. As you know, we've got a raffle happening, so we've got a prize for 2 tickets to Chelsea Flower Show on Thursday the 21st of May. So do grab a ticket if you haven't already. They're £5 each, £20 for 5, and the proceeds are being split between DABS, which is a domestic abuse charity, and the Pickering Cancer Drop-In Centre. 2 great charities that are close to our hearts in this room. We've got quite a few of our friends from Bury & Lambert's and Maddisons and TN Accountancy here. So anybody from any of those, just wave your hand now in the air. That they're all oh look, bless, some of them have got seats there. Yeah, some of them are at the back there. So, you know, in the break, do feel free to come over and mingle with us and ask any questions that you might have. Before I officially hand over, I thought it might just be useful to give you a bit of an update on what the residential sales market is like at the moment. So within Maddisons, I head up the sales department, and the number one question that I'm always asked when I'm out and about is, what is the market like at the moment? And people ask with a sort of sense of pity in their eyes that I'm just going to start crying and it's absolutely dreadful. The reality is, within this lovely part of the world that we live in, such beautiful architecture, amenities, green spaces, our excellent transport links, and of course that coveted schooling means that we remain a very needs-driven market. So the reality is, the sales market is absolutely fine. It's a buyer's market, a price-sensitive market, so you cannot sell at the moment for an unrealistic price on a badly presented property. Buyers have an awful lot of choice. And they will use that choice to their advantage. They will also leverage on all the geopolitical stuff that's going on at the moment in terms of what's happening in Iran, thinking that makes them the strongest buyer on the block. But the reality is, they just need a bit of bossing around and understanding that they can't negotiate as hard as they might like. And with careful negotiation, you will absolutely get that deal done. So first half of the year has been really strong. Prices have been relatively static. The big engine rooms of Tunbridge Wells have been TN2 and TN4. Average price achieved about 476,000, but lots going on in that big 1 million plus market as well. And houses are the big bellwether of the town still. So 2/3 of sales will be houses, only 1/3 flats, and bungalows, when they come on, they're still very, very popular. So the market is fine. We've had a great year. We had our best year ever last year, which people might be surprised to hear. The mortgage market is not particularly affecting things. It's just an adjustment, not a complete heart attack. So yeah, it's all good in the world of sales. But now I'm going to stop now talking about sales and hand over to the world of lettings. So let's take you on a journey on that. And I'm going to hand over to James.
So, I don't know how close to sound to this, is that okay? Yeah, okay. Well, thank you again for coming, as Deborah said. What we wanted to do this evening from the lettings perspective is essentially send you home much better informed and hopefully calmer with regards to what has changed most recently in the lettings market. There's been an awful lot of press comment of the fines that are happening, and that has scared a lot of people, people I've been speaking to over the last couple of weeks in the run up to this, and indeed a couple of people just here this evening. So tonight I'm not seeking to add to that. And the promise that I would like to give you tonight, and those fellows that I'm standing up here speaking, will be speaking later on, is that you will leave better informed, better equipped and more in control. Every speaker here tonight that Deborah's introduced already, Berry and Lambert's, TN Accountancy and Paul, are people that we've, certainly with the locals, people we've trusted and worked with and spoken to a lot over the years. Next slide, please.
Yes.
So, I was going to say a little bit about background on Maddisons, but Deborah's given you a little bit about that. We are a family-led agency, Deborah and I running this, and we've got a team of 17 in total. And we say that we're a family business because we feel that's really important. From the lettings perspective, we do not manage from behind a desk. We know this area really well. I've lived in the area since the early 70s. We know our properties. For those of you that work with us already, you'll know Hannah and Becky, our lettings manager, and Hannah, our property manager. They come out and they visit every property regularly, and they understand and know all of the properties and indeed all the tenants within those properties. When rules change, which they do constantly, and we'll go on and see that in a second, what Maddisons hopes to bring you is that a team that you can have absolute confidence on, and where all the management and compliance is taken care of under one roof from our office in Tunbridge Wells on the Pantiles. So, as I said, rules have changed constantly. I bought my first rental property back in 2000, and if we cast our mind back then, some of you may have owned properties from that time, and some subsequently bought them subsequently. But if we go back to 2000, you'll remember MIRAS, Mortgage Interest Relief at Source. So in April 2000, MIRAS had just been abolished, but the residue thinking from MIRAS was everywhere, and that property ownership came with generous tax exemptions. We're going to hear from Jack that that's perhaps not quite such the case now. Mortgage interest was simply a deduction against rental income and not a restricted credit as it is today. Capital gains tax, CGT, people remember taper relief and indexation allowance. So the longer you held a property, the lighter the tax at the end of it. Wear and tear allowance used to take 10%, no questions asked, no receipts required. There wasn't any stamp duty surcharge on second properties, no deposit protection scheme, no EPCs, no EICRs, no licensing or indeed selective licensing, no right to rent checks, and Section 21, well, as of last week, obviously, that was stopped. This isn't to be nostalgic, but it's just to show what was there not so long ago within living memory, obviously, but how things have changed and how the goalposts have moved. So here we are in 2026. As I say, MIRAS, Mortgage Interest Relief, no longer a deduction, it's a 20% tax credit, courtesy of Section 24. Wear and tear allowance, well, that went in April 2016, and you can now only claim what you actually spend, and you need the receipts to prove it. Capital gains tax, the annual exemption was 12,300, it's now 3,000. Stamp duty, a zero surcharge on additional properties became a 3% surcharge in 2016 and a 5% surcharge from October 24. And on top of that, deposit protection, EPCs, EICRs, smoke and carbon monoxide alarms, right to rent checks, tenant fee ban, 5-week deposit cap, all things that simply didn't exist 20 years ago. The reason I say this isn't to make us all feel somewhat sad, but it's just contexting where we are now and the importance that the landlords who will do best from this are those that understand exactly what has changed and why. And that's why myself, Darren, Jack and Paul are here tonight. So if we go into what has changed over this last decade, Section 24 was announced in 2015 and phased in between 17 and 20. And it removed the ability of individual landlords to deduct mortgage interest rate as an expense. You now get a 20% tax credit instead, and for any landlord paying higher rate tax, that's been the single most painful change of the last decade. In fact, April 2016 was quite a hard month. In one go, wear and tear allowance disappeared, and a 3% stamp duty surcharge on additional properties came in. Then in April 2020 came the requirement to report and pay CGT within 30 days of a residential disposal. They have now increased that to 60, but it has caught a lot of people unawares. And the CGT exemption, as I said, that was 12,300 and it's now 3,000. In October 24, the stamp duty surcharge jumped again from 3 to 5% overnight. So taking a £300,000 buy-to-let, which is quite standard in Tunbridge Wells, that single charge added £6,000 to the upfront cost. From April this year, the nil rate band was reverted, so even standard stamp duty is biting harder. Jack will pick up on all of these things for you in a few minutes' time. The other half of the picture is compliance and tenancy law, and this is where the day-to-day running of a let property has really changed beyond recognition. I've referenced smoke and carbon monoxide alarms becoming mandatory, and that was in 2015, and then the requirements were expanded again in 2022, so you now need an alarm on each floor of the property. We're also all aware of minimum efficiency standards coming in for new tenancies, and by 2020, and that the goalposts on EPCs are moving again, and this has been a can that's been kicked down the road, with proposals for a C requirement by 2030. The Homes Act gave tenants the right to take action where a property isn't fit to live in. We had the Tenant Fee Act in 2019, with most fees gone, deposits capped at 5 weeks, and that really did change the estate agency model and cash flow at the start of every tenancy. And then in April 2020, the EICRs were brought in, requiring recommissioning every 5 years. Then of course COVID hit, and that brought temporary but very disruptive changes with 6-month periods, court backlog that still linger today and are one of the main worries for us with the new legislation that's come in. So, we are now 6 days into the Renters' Rights Act, and for landlords who self-manage, the risks have changed in a way they haven't changed in a generation. Section 21 is no longer a thing. Fixed-term tenancies have gone, possession grounds have been rewritten, and there is now a new ombudsman, a new database, and councils that have stronger powers and can levy large fines. The legal landscape has significantly become more demanding, and getting the small things wrong can carry a real cost, and we'll hear from Darren on that. But the good news is that you're not having to navigate this on your own, and we sincerely hope that with the presentations that you hear this evening, you will leave here much, much better equipped. Letting a property was for the most part something I think that people were able to do on the side of their main employment. Certainly that's how I started off when I bought my first property in 2000. But that world is now gone, and it's gone particularly quickly for landlords who self-manage. Today, owning and renting a property is a full-time discipline. Compliance certificates with hard deadlines, reporting and tax obligations with strict windows, tenancy paperwork that has to be precise to the comma, because under the new regime, a small slip can void a notice or trigger a repayment order. The consequences of getting it wrong are no longer a "we'll fix it next time." They're fines, court delays, lost rent and reputational risk. Meticulous organisation has become non-negotiable. Most landlords that the team speak to on a day-to-day basis manage their properties really well. They handle the maintenance, the certificates, and support their tenants brilliantly. The harder part, and the part that has changed most, is planning ahead, managing the risk, navigating regulation as it shifts under your feet. And I think that's a useful distinction. Property management is the day-to-day, the repairs, the compliance certificates, resident support, rent collection, tenancy admin, the mechanics of running a let property well. Asset management is the longer term view. It's reviewing whether each property is still earning its place in your portfolio. It's anticipating where regulation is heading next and aligning the decisions that you make today with the longer term performance of the asset that you own. The reason I draw the distinction to this is under the old lighter touch regime, property management was almost a whole job. Under this new regime, we feel that asset management matters just as much, because the cost of being caught out by the next change is much higher than it used to be. What we do at Maddisons is both. We proactively, not defensively, look after the property. What we offer is detailed local knowledge combined with structured oversight. We know your homes, we know the local area, and we help you place the right tenant in the property for you and yourself. And underneath all of that, we run the kind of disciplined process that the new regime now demands. Full management is end-to-end, where we market the property, find and reference the tenant, manage the tenancy, chase all the certificates and renewals, and collect the rent. It is your sleep at night factor. However, we also offer collect and protect, and that's for those of you who enjoy running the portfolios for yourselves and the involvement. We don't ask you to give that up. You keep the parts you enjoy and let us handle the technical, legal and compliance aspects. We tailor it around how you wish to work. I think underneath both, something I'd really want to highlight is the importance, and Paul's going to mention this later on, of rent guarantee and legal protection insurance. We've spoken to all of our landlords about this, and the majority of our landlords now have rent guarantee and legal protection insurance in place. We think it's absolutely key to future management of your properties. So if I leave you with one question, it's just this. Tonight, you've heard from me about how the market's changed, and I think the reason that you're in the room tonight is because you understand that there has been significant changes. The question really is, are you ready for this? Do your current arrangements still match the world that you're actually operating in today? And do you feel genuinely secure under the new tenancy regime, or are you hoping for the best? If the honest answer to any of these is not really, I hope it's reassuring to know that with the people that you've got here tonight, that support is at hand, and we're here to help you as and when you need us to. Thank you. What I should say is that we've got a brochure to hand to everybody this evening that will summarise some of the key aspects of the legislation, so please do ensure you take one of these before you leave.
Thank you very much. So I'd now like to introduce our next speaker, who is Darren Forrester. So Darren is a partner and head of the Dispute Resolution Department at Berry and Lambert Solicitors. Darren specialises in property disputes, including landlord and tenant law. Berry and Lambert Solicitors is a long-established full-service law firm based in Kent and the surrounding areas. They specialise in residential and commercial property, private clients, including wills and probate, family law, commercial law, and dispute resolution. They have offices in Tunbridge Wells, Sevenoaks, and Paddock Wood. Darren works regularly with landlords and property professionals to resolve disputes and navigate the professional and emotional challenges that come with this area of the law. I'm pleased to invite Darren Forrester to provide insight into the legal framework of the Renters' Rights Act 2025.
Thank you very much for those kind words. It's almost like I wrote them myself. I'm really here to give you guys a whistle-stop tour of the Renters' Rights Act, because I think everybody knows or has heard about it, but this is just a guide so you can understand exactly what's going on, what you need to be prepared for. So in terms of agenda, we're going to look at the end of fixed-term tenancies, The big headline is the abolition of Section 21 notices, which has been in the news and everybody knows about. We'll look at the new and the amended grounds that you can seek possession using a Section 8 notice. We'll then go on to changes to rent increases and how that works. Then we'll look at the key dates, and then we'll finish up with your duties as a private landlord. Okay, so all of you here who are landlords have previously had assured short-held tenancies, which had a start date and an end date. Now, what would happen with those contracts is that you get to the end of the term, and then if you don't enter into a new tenancy agreement, it rolls over periodically. What's happened now is that under the Act is that you just have a contract start date, and it rolls periodically from month to month. So that's really important. Okay, next slide, please. So, the abolition of Section 21 notices, the big headline. So there are no more no-fault evictions. So Section 21, just to give you a recap, allowed landlords to decide that actually they want their property back. Maybe the tenant wasn't right for them or they wanted to move on. They did not need a reason. There didn't need to be any fault on behalf of the tenant. They would serve the notice, and if the tenant didn't move out, you'd go through a process called the accelerated possession procedure. That effectively, the right to serve that notice has now ended as of the 1st of May. Okay, I'll go on a little bit later to talk about how that works in practice going forwards. Landlords who now want to seek possession of properties under the new Act must do so only using the Section 8 notice, which gives new grounds for possession. Okay, I think you've jumped forward to. Okay, so the first ground is ground 1, which allows landlords to seek possession of properties where they want to move back in or they want a close family member to move back in. Okay? The notice period for that is 4 months. The notice, though, cannot expire until 12 months after the start of the tenancy. So this opens it up to people to be able to go back into the property themselves or get their family in there. All right, the big sort of headline one is ground 1A, which is where a landlord intends to sell the property. Now, a lot of landlords used to believe that they always had this right, and many came into our offices believing that, okay, I want to sell, I need the tenant out. That right did not exist before, it does now. So it's good because it gives landlords that opportunity and that flexibility, but there are ties to it and there are penalties if you try to abuse it as a landlord. So the notice again is 4 months that you need to give to your tenants. The notice cannot expire before 12 months of the tenancy starting. And what I will say about this, and the first one, they are mandatory grounds. What that means is when you go to court, as long as you can prove ground 1 and ground A, the courts do not have any discretion to allow the tenant to remain in the property. They have to give you possession back, and that's key. All right, so with this, the point on 1A, which is the devil's in the detail, as with all things legal, is that if the landlord uses ground 1A, they're selling the property, they cannot then go on, the tenant leaves, and then they get somebody else and they re-rent it. There are penalties if that happens. There's a 12-month period, either from the expiration of the notice, or if you go to court, from the date that you get the possession order. So it's really important that you take that away, because a lot of landlords, a similar system was introduced in Scotland, and people fell foul of it, and we imagine the same thing's going to happen here. Whether in time there will be changes.
How are they going to police this?
Well, I mean, I imagine what will happen is there'll be a tenant or there'll be people looking around. There may be firms who go and check these sorts of things. Who knows? I think with all this, it's all so new that we don't actually know what's going to happen and what it's going to look like. But the reality is we just need to be aware, because what will happen is there'll be one case which will start the floodgates will open.
On the occupation of a close family member,
Sorry, just to say, there is going to be a section at the end for questions and answers, because they've got them in a very tight timetable. Right, so that's a key point. Next slide, please. Okay, so ground 6. This is a ground that existed under the previous regime, but the notice period has increased from 2 months to 4 months. This is where the landlord wants to demolish or redevelop the property. Now, the intention must be that the landlord wants to do these things and that the tenant cannot remain in the property while these works are taking place. Okay? This, again, is a mandatory ground. So as long as you can prove these aspects, then you will be entitled to possession of your property. The one sort of red flag on this is if you purchase a property with a tenant in situ, you cannot then use this ground. So it's really important that you know that and you do your research beforehand. Next slide, please. Okay, then we get to the rent arrears grounds, grounds 8, ground 10 and ground 11. Okay, there have been slight changes to these, but they're not too dissimilar to what was previously in place. There's been an increase in the amount of rent that's required under ground 8, and ground 8 is a mandatory ground, and it's where under the new regime there are 3 months or 13 weeks of rent owing. In that case, you can serve your Section 8 notice, and as long as there is 3 months or 13 weeks rent owing at the date of the notice and at the date of the hearing, you are entitled to possession of the property on mandatory grounds. Okay? Now, one thing you do need to bear in mind with this, and this is one change, again, devil's in the detail, is if you have any tenants that are on universal credit and the universal credit is causing these rent arrears, that amount under ground 8 is disregarded. So effectively, if, for example, your rent is £1,000, the universal credit pays £800 of that, and £200 is the tenant's responsibility, then if you're relying on ground 8, you would need that £200 to calculate and roll up to 13 weeks before you're able to use this ground. So what you always do when you serve these notices is you would go for ground 8, ground 10 and ground 11. Ground 10 and 11 deal with general rent arrears and persistent delay in paying the rent. They're both, I mean, all of these are 4 weeks notice that you need to give. But what it does is it gives you some protection. So if you're in a situation where the arrears have grown to your 3 months at the date of your notice, but the tenant then pays and reduces it below that amount, which is a tactic that they use, you can then use one of the other grounds, which is a discretionary ground, but at least it keeps, you've got a horse in the race still, effectively. So it's just keep an eye on these things, and discretion means that even if the court finds that there are rent arrears, the court can give an order to say they have to repay over a certain period of time, or you can have a suspended possession order. So we just need to be aware of these things. Okay, and finally, there are other grounds, but we'll just go through the ones that are most likely to affect you. I did a count, because I'm boring like that, of the amount of grounds there are. There are 18, and then it's got subheadings, so you end up with about, I think there's over 35 of them. But the one that we come across often is nuisance, annoyance, illegal or immoral use of the property. There is no minimum period of notice that you need to serve for this ground. We've had things like properties used as brothels and drug houses, noisy neighbours, abusive and violent people. So it means you can serve your notice and then get in front of the court as soon as possible. Okay, next. So, Section 8 notices, what you need to do. As James has said, it really, your role now as landlords is changing. It's becoming more and more professional, and property professionals are here to help you, and law firms like us are here to help. When you're going to do these things yourself, what you need to do, you need to make sure the Section 8 notice you serve is a prescribed form on the government website. What I would advise is if you're going to be doing a few of these, don't just keep a precedent that you use and then keep using the same one every time, because these laws and these forms change. So it's really important that you're up to date. So go on the government website. It's got some great advice and information for you. Okay, make sure your grounds are clearly detailed. Where applicable, use as many grounds as possible. So for the example of the rent arrears, you use 8, 10 and 11. Ensure that the correct notice period is provided. As we went through earlier, there are different notice periods for different grounds. So you need to make sure you're in tune with that. Also, when it comes to serving notices, and I'll come on to this a bit more, it's important that you make sure you've served the notice properly in accordance with your tenancy agreement and in accordance with the Act. Next slide, please. Okay, so we'll move on from that to rent increases. So many of your tenancy agreements will have a rent review clause. It's redundant now, it means absolutely nothing. The new regime is that a Section 13 notice must be served. That notice must be in the prescribed form, which is Form A. It's published on the government website, so again, you guys can all check that out. It must give at least 2 weeks, 2 months, sorry, no, 2 weeks would be great, wouldn't it? 2 months notice. And that rent must be at no higher than the market rate. So what is market rate? I mean, that's a question that we'll have to answer. So, go to the next slide. The rent increases now can only take place once every 52 weeks, so effectively once a year. However, under the new regime, the tenants have an opportunity to challenge the rent in the first tier tribunal. And what the fear is, and the big kicker to this, is that whilst the challenge is in the tribunal, your rent cannot be backdated. So the court system, the first tier tribunal, having dealt with it many times, is one of the best tribunals that we have. But it's imagined that there's going to be an influx of cases that come in, which is just going to grind it down to a halt. So what effectively is going to happen, potentially, is that you serve your notice on the 1st of January, for rent to start on the 1st of March. Around the end of February, your tenant potentially then challenges. That goes through the court system. That system takes 6 to 9 months. The rent is effectively a rent freeze by the back door. And so that process goes on and on and on, and that's a real worry. So that's something you all need to be aware of. I'm sure that Paul will dive deeper into that. Thank you very much for that. Sounded like a applause my phone. All right, next slide, please. Okay, so then we'll look at your duties as a landlord. So landlords must provide new tenants and some existing tenants who have not got written agreements with written information about their tenancies. The one thing that you need to be aware of for all you landlords who have got tenants who are in situ before the 1st of May is that you must, and the word here is must, provide them the Renters' Rights Information Sheet 2026, which is available on the government website, to give them information about all of these changes. It is imperative that you do that if you have tenants and you have not already done so. Did you see how I changed my tone there? Did I sound really serious? Good. It really is important, guys, because there are potentially fines up to £7,000 if you don't comply. So I think it's really important that everybody gets a grip on that and knows they've done it. The deposit continues to be protected. That doesn't change. In the future, there will be a database for landlords, with only registered landlords being able to let properties. This act is coming through in phases, and we're very much in the first phase at the moment. Next slide. Okay, so again, landlords will then have to become members of the landlords redress schemes. The enforcement action is going to be by local authorities, civil penalties up to £7,000 for sort of quite minor infringements, going anywhere up to £40,000. So it really is a change in the landscape and the punishments that can be sent your way. And I mean, the maximum there is criminal conviction, so we certainly don't want that, guys. Next slide, please. Okay, so just running through the key dates. So everybody knows 1st of May, no more Section 21 notices. So how that works is if you served a Section 21 notice prior to the 1st of May, then you have until the 31st of July to issue court proceedings under the accelerated possession procedure. And when I say the word issue, normally what happens is that paperwork goes to the court and it gets a stamp to say it's issued on that day. But you may have sent it to the court 2 or 3 days before, but it might not get processed until later. Now, the general rule in most cases is that the issue date is effectively the date that you've sent it to the court. It's been received by the court, not the date it's been issued. But there is a real risk that the courts and tenants pick up this point and say, well, actually, the stamp on the seal is later than the 1st of July. So it is really important, if you have served your Section 21 notice, I want to build up the tension there. If you have served up your Section 21 notice, get your accelerated possession procedure issued as soon as possible. Do not wait. We have had, as a firm, on the final days before the 1st of May, we had to do a number of Section 21 notices, and they're out, and that's fine. But you don't want to take that risk when it comes to issuing court proceedings, because it can be a massive headache. Okay, and then, so just go back to one moment, and then it's just the key date of the 31st of May, which we spoke about getting the information sheet out, so make sure you do that. Okay. So, key takeaway, this is the final big finish for me. So, ensure your paperwork is dealt with. Really important, make sure you go through it. If you are unsure, speak to your property professional or your lawyers to make sure it's all right. It's more important than ever, and James touched upon this, that you have insurance, because you can cover not only missing rent, but also legal fees, which are very reasonable at Baron Lambert's, but still I understand not to pay them. You need to make sure your tenancy agreements are clear. You cannot, in your tenancy agreement, contract out of the Act. So the Act is the Act, but what you can do is try to work with it as much as you can. What we would always suggest is in your new tenancy agreements, you include a provision for the recovery of legal costs. So that's a contractual provision, so that at least if we get to court, we can argue for that. We might not get it all the time, but for the sake of putting a paragraph in your tenancy agreements, why wouldn't you do it? Allow for services of notice and documents by email. So a lot of people will only have the address for service of documents and notices as the address for the property. Have a provision in there that you can do that by email, because it saves time. What we tend to do when we serve any notices is we serve them by email, we serve them by first class, and we serve them by recorded. And on occasion, we even go to the property and put it through the letterbox. Belt, braces, a belt again, another set of braces, I think that is. So if you are going to serve a Section 8 notice, make sure you use the prescribed form only. Do not use any of the old ones, and make sure you understand the relevant grounds that you're relying upon, and you've got all the relevant information. And I think finally, it's really important that you understand, and James touched on it, and I'll touch on it again, and I think Paul will do the same, it is a professional business of being a landlord, and you need to be prepared. You need to either have the knowledge yourself or have professionals around you who can advise you, because the pitfalls, if it goes wrong, can be quite severe. So my name is Darren Forrester. Thank you very much. It was amazing.
Right, one more section before we have a comfort break. So thank you. There's some heavy stuff there, but delivered beautifully, I thought, with a bit of humour as well, which always helps. So our next speaker, we're going to have a question and answer session right at the very end. So save up all your questions for then, after Paul's slot as well. So our next speaker is Jack Sales. He's a chartered tax advisor and has nearly 15 years experience, with the first half of his career being spent in tax teams at large accounting and advisory firms before setting up TN Accountancy in 2018. TN Accountancy offers a broad range of services to both personal tax clients as well as business owners and landlords who own investment properties in their own names, as well as within corporate and trust structures. So a big welcome to you, Jack, please.
Evening everyone, nice to see you all. I'm here to talk to you about tax. Don't worry, I'll keep it brief before you all nod off. The main kind of topical piece at the moment is making tax digital, which is coming in at the moment. But before I talk about that, I'm going to just talk a little bit about broader structuring of your property portfolio in a tax efficient manner. James, it's kind of a follow-on from James's helpful history lesson at the start, talking about all the changes there have been from a tax perspective over the last 26 years, back to 2000. So essentially, when we're looking at whether to buy a property personally or in a company, there's no one-size-fits-all answer. And I appreciate a lot of you are going to be existing landlords. You've got your pre-existing properties, and changing from one to the other is a taxable event in itself. But I guess this is more relevant if you were to buy your next property, for example. Next slide please, James. So with regards to holding property personally, as James mentioned, there is now a restriction on the tax relief that you get for mortgage interest against your taxable profits. So this came in originally in 2017 and was phased in over 4 years and was fully in effect from 2021. At that time, that prompted a lot of kind of noise in the industry about basically having or holding investment property in a company, and I'll come onto that in a second. So as you, yes, of course, sorry. Is that any better? Excellent. So where you hold property personally, the rental income effectively sits on top of your pre-existing income. So if you are a basic rate taxpayer and you've got sufficient headroom in the basic rate band, then your rental profits will be taxed at the basic rate to the extent that you've got headroom available. If you're a higher rate taxpayer or an additional rate taxpayer, then the tax rate on the rental profit will follow suit. When you come to sell the property, then you're looking at capital gains tax on the sale, and that is going to be at either 18 or 24% depending on your overall tax rate. Next slide please, James. Conversely, if you hold rental property in a company, the main difference from the ongoing income side of things is that you get full deduction for the mortgage interest that you pay on your property. So instead of it being restricted at the basic rate, you basically treat mortgage interest as a regular tax deductible expense as you would with any other expense. The big difference really with a company is the fact that you effectively now have, well, back in 2021 I obviously mentioned about the noise around moving over to holding property in a limited company. That was back when the rate of corporation tax was a nice flat 19%. But then in 2023, HMRC in their infinite wisdom decided to change that, and they upped the tax rate by 6% up to 25% on as the main rate of corporation tax. That's in addition to any income that you decide to take from the company, and that's the key thing when you're looking at your overall planning, because if you're planning to effectively retain money in your rental business and retain those profits to invest in another property, generally speaking, a company is generally more tax efficient. Sorry, next slide please, James. Whereas if you were looking to live off of that income, then you've got a second layer of tax. So if you're paying corporation tax at anywhere between 19 and 25%, and let's say you're a higher rate taxpayer, you're then paying an additional now 35.75% on the dividend income that you're taking from your company. So if you're looking to kind of live off of that rental income, then potentially a company might be quite tax inefficient. The other thing as well to consider is when you're coming to sell the property. So if you're selling personally, you've got one layer of tax again, so it's your capital gains tax rate. Whereas with a company, you've got corporation tax when you sell a property, but the money's still in the company. You still need to take that out, and that's either, broadly speaking, that's either going to be taken as dividend income, or if you decide to liquidate the company, then you then pay capital gains tax on top of the corporation tax that you've already paid. Whether one is better than the other, it completely depends on your individual circumstances. So an example of this might we have clients with all different circumstances. So just using a really straightforward example of someone who's got a single rental property that generates a £20,000 profit per year. We've got one client who might be a basic rate taxpayer. They're effectively getting taxed at 20% on their rental profits. They're getting 20% tax relief on their mortgage interest. So actually the mortgage interest restriction doesn't have an effect for them. Whereas another client, they're a high earner, they're earning about £100,000 a year salary, then they've got a £20,000 rental profit on top of that. They're effectively paying 60% tax on the rental profit before we even consider the mortgage interest. So in that scenario, that client doesn't really make a lot of sense for them to hold that property personally, because they're paying so much tax that it's actually completely wiping out their profit, whereas the base rate taxpayer holding the property personally actually works quite well. Next slide, please, James. A few other kind of side considerations as well. Obviously, there's when you're looking at your property investing journey, you're looking at your entry point. So you've got your stamp duty when you purchase the property. They're broadly the same when you're purchasing either in a company or personally, but there are small differences. You've got your income tax as you go on your rental profits, so that's again income tax versus corporation tax, and then you've got your kind of exit tax, so you're selling your property and you're either paying capital gains tax or you're paying corporation tax and capital gains tax when you end. So it all depends on what your overall kind of plan is for the long term. Next slide, please, James. So on to making tax digital, which is now coming in. So originally, making tax digital was planned to be introduced by HMRC back in 2018, but they're, surprise, surprise, they're quite inefficient. So it's been delayed again, and it's finally happening. So a lot of you will be aware of the broad premise of making tax digital. So we are going from the old system where we basically report our rental income. This only applies, by the way, to personally held properties. If you hold property in a company or in a partnership, making tax digital doesn't apply. But making tax digital is basically a move from the old system of doing a single tax return once a year, where you're putting everything on there, to doing that year-end return anyway, plus 4 quarterly returns. And you're required to do, so if you happen to be an unfortunate person who's self-employed, has got UK rental property and overseas rental property, you will need to do 3 making tax digital returns every quarter. So we've got some clients who've got all 3, so they are basically having to do 12 extra returns every year. What's it for? No one knows. So there is initially no change to the timing of tax payments. So at the moment, you're all familiar with doing your 31st of January main tax bill, and then for certain clients as well, having a 31st of July payment on account. That's staying exactly the same. The quarterly updates are initially there just as a piece of reporting to HMRC. I guess the thought process internally within HMRC is it's basically designed, or they believe it's going to help close the tax gap. So a lot of people panic and do their tax returns on the 31st of January. They cobble together their records and get their tax returns in. This is at least what HMRC say. And they believe doing things on a quarterly, regular basis, people will be doing record keeping more often, and basically be getting things right, in theory. We'll see. So it's a phased rollout. So phase 1 is basically coming in at the moment. So if you had relevant income, so that's combined turnover from rental property and self-employment income of 50,000 or more in your 2024-25 self-assessment tax return, you'll have to start quarterly reporting from this tax year. So the first return will be for the quarter end of 5th of July, and it's due by the 7th of August. So in terms of timings and deadlines, it's a bit like a VAT return. Effectively, you've got a month after the quarter end to get your return filed. The next phase that comes in next year, if your relevant turnover is 30,000 in your 25-26 tax return, so the one that we're doing at the moment, then you're going to have to start quarterly reporting from next year, and then £20,000 the year after. People have to start quarterly reporting from 2028. Next slide, please, James.
Sorry, can I just quickly ask?
Sure.
Your entire income?
Your relevant income, so that's your turnover from rental. It's basically rental income, and if you're self-employed as well.
Right.
But if you've got pensions, dividends, employment, that doesn't count. So what does it mean in practice? So the big thing is going to be a big change from HMRC receiving your self-assessment tax return with headline figures, with no link back to the transactions. What making tax digital effectively means is that there has to be a digital link between every single transaction and the figures that get reported on a return. The kind of ideal from HMRC's perspective, and particularly as they're not actually going to offer their own software, they're basically putting the onus on taxpayers to use a commercial software supplier, is basically reporting to HMRC your, so for example with rental income, you're going to have to link or have a digital link between every payment of rental income that you receive and then every item of expenditure that you incur. And the data basically has to link up and we have to include dates, amounts and category of the income, and that all has to link into the figures that actually get reported to HMRC. So as I mentioned, there's obviously a requirement for software. I've mentioned they're not spreadsheets alone. The reason for that is you can still use a spreadsheet, and for some of our clients, or actually a fair few of our landlord clients, we are in this first phase going to still be using spreadsheets, but then having basically spreadsheets set up in a very particular way and having bridging software that bridges the gap between spreadsheets and HMRC system. Next slide please, James. So what does this mean? I mean, this basically kind of fits in with the theme of additional regulation and additional red tape, a lot more work for landlords to undertake. And essentially, and again, for a lot of our clients, there's going to be a big shift from kind of looking at, you know, basically getting, for some clients, basically throwing their information at us once a year to get the tax return done, to having a more of a systematic approach, keeping on top of things regularly, so that you know, we're not going to have this mad rush every quarter. And I mean, it's basically moving having a property investor running things more like another business where you're having to do record keeping more regularly. In terms, I mentioned penalties there. There is a soft landing, so for this first year there aren't going to be any penalties for any late submissions. Although we are saying to the clients who are in the room, that doesn't mean that you don't have to send us your information. Next slide, please, James. So how it can help? So on the first kind of part of the presentation around kind of overall tax efficiency. So we do a lot of kind of tax strategy sessions with clients. So this is generally more pertinent when someone begins their property investment journey and they're looking at how do we structure things. We will have a session with them and look at what's your goal, what's your, what are you doing it for? Is it to be passed on down the generations? Is it to support your income now? Is it to support your income during retirement? The answer to that will basically drive the best structure for you. We can assist with that, and we can also assist with the ongoing compliance. And then making tax digital, yeah, we're all over that as well at the moment. That's keeping us very busy. That's all from me. Thank you very much.
Thank you very much, Jack. That was really interesting. Actually, I learned quite a bit on that. So